Well, thank you for all coming to our little investor event. I won't read that to you, but we've revisited our mission statement and our company values as part of our QCA work. And you'll find that on our website, emblazoned at the front. So today, we thought you'd enjoy seeing some other people than me, particularly other people than me. So John Furber, our finance director, is going to go through our 2018 financial year results, just the highlights of. Just to remind you of those of you that missed our roadshow. Mark Watkins, who's Chief Operating Officer, will talk to two strategies. We identified three strategies in our annual report. They were around having, my words, improving efficiency, having the best tech, and selling a lot more. And so there'll be three little strategy presentations on that. So I'll hand you over to John.
Good morning, everybody. I'm pleased to be here, part of the Trakm8 team, and to talk you through the performance in the last financial year. That's a performance where we were pleased and felt that we made strong progress. And before I move on to the key financial highlights, I thought I'd just talk you through some of the key operational improvements and benefits and progress that we made in the last financial year. One of the key things that we did was exit out of the subcontract electronic manufacturing. We've been discussing that as a key strategy for us over the last couple of years. And by the end of last financial year, we were fully out of the subcontract electronic manufacturing. And that allows us to focus our energy and resources on being a pure play telematics provider. At the start of the financial year, we set ourselves an objective to reduce our annual operating costs by £1.5 million. Pleased to announce that actually we exceeded that and reduced our operating costs by £2 million, which enabled us to significantly increase our investment into sales and marketing, and you'll hear more about that later. We had over 30% growth in our connections, and obviously that's a key metric for us in terms of measuring and tracking the number of devices that that are connected to our servers. So that was pleasing growth in our connections year on year. We have continued to invest strongly in engineering, and two of the kind of key outputs of that were launched in the financial year with the launch of our new fleet management platform, our next generation of platform being Insight, and our integrated 4G camera and telematics device that we call the Roadhawk 600. And you'll hear more from Mark later around those two key outputs from our engineering spend over the last few years. We've also continued with new contract wins, and you will have seen in some of the announcements in terms of a couple of the key ones. The contract win within Telematics Europe during the financial year, which is a joint venture of 3 European roadside assistance clubs, along with Telematics from Australia. And that was a key contract for us in the automotive space. Cala, which was a fleet contract, and contract extension with Iceland Foods, and that contract extension with Iceland Foods sees Iceland taking our entire solution. So that's our 4G camera and telematics device, so the latest cutting edge telematics technology, along with our optimization solutions and providing them an integrated solution for their home deliveries. And finally, I've already touched on the R&D. Finally, we have been focused, as I said, on driving operational efficiency, and part of that was integrating some of the previous year's acquisitions. And as part of that integration, we closed 2 of our offices in the UK and centralised the effort and work in our other 2 remaining offices. So we closed our Bodmin office, which was as a result of the acquisition a few years ago of DCS Systems Limited, and amalgamated and centralised that in our Coleshill headquarters in the West Midlands. And we closed our Livingston office, and again consumed that key engineering effort in some of our other engineering centres, including Prague. So going forward now, we operate out of our headquarters in Coleshill in the West Midlands, and then we have a engineering centre of excellence down in Shaftesbury, and we have our office in Prague, which is focused on serving our Eastern European customers, and also is a engineering centre for us. So hopefully that gives you some insights into the operational progress that we've made during the financial year. And I'll now move on to talk through the financial highlights. And what you'll see on the next slide are the key financial metrics and strong progress in all of those key metrics. Revenue up 12% year on year, and I've got a couple of slides that actually show the true underlying growth of our core telematics business, which we call solutions revenue in terms of our external reporting, and actually that grew by 26% year on year. Significant improvement in profitability on both of the profit measures, so profit before tax and the key measure in terms of the ongoing profitability, the adjusted profit before tax. And you can see significant improvement in both of those metrics. The key difference between the profit before tax and the adjusted profit before tax was the one-off non-recurring exceptional costs that we incurred during the financial year. And we've taken the business through a significant change during the financial year, and that shouldn't be underestimated. And as a result, we have incurred a number of one-off non-recurring costs during the last financial year, relating to moving the head office, relocating the head office and central and back office functions from Shaftesbury up to Coleshill. As I've already touched upon, integrating the acquisitions and closing offices, exiting out of the subcontract electronic manufacturing. Not only have we significantly improved profitability year on year, but also that flowed through in terms of strong and positive cash generation, and you can see the significant improvement in the cash generation. And the metric I've got there is the cash generation from operations, and I've got a bit more detail on that later. That 4.7 million does include the R&D tax credit of 1.6 million, and even if you exclude that, the underlying business excluding that is still very strong growth year on year. From a earnings per share perspective, as you would expect, significant improvement on the adjusted. You might spot that the basic earnings per share was actually down year on year. The reason for that was in the prior financial year, there were a couple of one-off tax benefits that weren't repeated in this current financial year due to catch up on the R&D tax credit from the previous financial year and recognition of deferred tax assets. So the reason the basic earnings per share is down is due to one-off tax items, and the adjusted earnings per share is reflective of the improved financial performance of the business. As I said, wanted to provide more detail in terms of the revenue growth year on year. So in terms of our external reporting, we split it down into solutions, being the telematics business, and into products. On this slide here, I'm showing where the growth has come from that's resulted in the 12% growth year on year, and I've split down the solutions revenue growth of 26% into the two business units, so into fleet and optimization and into insurance and automotive. And there's different dynamics within both of those business units, and I'll provide some more insight into those later. But what you can see in terms of the black bar is the 2.2 million decline year on year as a result of our decision to exit out of the subcontract electronic manufacturing. And it's that year on year decline through our strategic decision to exit out of that. Ultimately, it's, you know, non-value add and not in terms of the strategic direction that we're moving in. And it's that decline that has reduced our headline growth to the 12%. I really like this graph, and this just shows, because I think because of our exit out of the subcontract electronic manufacturing, our headline revenue growth has been depressed, and therefore, unless you go one level down in terms of understanding our revenue, you could be forgiven for thinking in terms of what the underlying growth of the telematics business was. So the bottom blue bar is our solutions revenue growth over the last 4 years. And you can see the decline on the green bar that sits on top being the products business, and how that revenue has decreased over the last 4 years. So actually our core telematics business has grown on a CAGR of 35% over the last 4 years, and grown at 20% plus in the last 2 years. So if we were never doing the subcontract electronic manufacturing and you were just looking at those blue bars and seeing that 35% CAGR, that's, you know, you'd have a true understanding of the growth of our telematics business. So that gives us, you know, great confidence in our decision, was the right decision to exit out of the subcontract electronic manufacturing, and we're doing the right things in terms of driving growth in the telematics business. For the first time this year in terms of our reporting, we broke down our revenue into the 2 business units, and as well as tracking the revenue, we track the connections, and obviously an increased number of connections will drive revenue both in the near term through new hardware sales, and will drive revenue in the medium term through the recurring service fees that we receive off the back of a new telematics sale. And dependent whether that's in the fleet space, on average that's a 3-year contract. On average, some are 1 year and some are longer, and in the insurance and automotive space, the contract length more matches the, especially in the insurance, the length of the policy, so is a 12-month contract. Connections in both our business units were up. You know, a focus for us is to accelerate growth in the fleet space. So, you know, pleased with the connections being up 11% year on year, but it's part of the business where it's a key focus for us to accelerate growth quicker than that. And as I said, the revenue that we're reporting under the fleet and optimization and the insurance and automotive, so in both those business units, we're selling that piece of hardware. We're potentially installing that through our third-party subcontractors, or if it's a self-fit device, which is predominantly the case in the insurance and automotive, obviously there's no installation revenue. And then we have the recurring service fees that provide the data and analytics on the back of the contract. Included within fleet and optimization are pure optimization sales. Revenue in the pure optimization side of the business was actually up just over 50% year on year. So that was a driver in terms of the 30% growth in the fleet and optimization business unit. Touched on the service fees, that's driven by the connections, and that drives the recurring revenue, and that is continued focus for us as well in terms of providing a sustainable recurring revenue stream for the future for the business. 10% growth year on year, and there's obviously a couple of dynamics that drive that revenue growth. So it's not as strong as our underlying telematics growth, solutions growth. couple of reasons. One, the strongest growth in terms of units has been in the lower priced insurance and automotive business unit. So therefore the impact on recurring revenue isn't as strong as it would have been if it had been more fleet biased in terms of our growth in connections. And then timing plays a key part in driving the recurring revenue as well. So obviously you start getting the recurring fees after the hardware has been installed, whether that's self-fit or we're installing it. We had a very strong fourth quarter. So of course the value of the service fees that you get off the back of that is much reduced because it's a month or 2 months or 3 months. Whereas if a unit sold at the start of the year, you'd have 12 months of service fees. So the growth in that's why the growth in connections drives the revenue in the medium term. In terms of profitability, this graph I think really highlights the leverage in our business model. So what we did in the last financial year, we grew our top line revenue and held our margin. Gross margin percentage, just to clarify, which drove another 1.6 million of profit. The 3 black bars and the green all relate to our overheads. That basically said that we kept our overheads, total overheads, broadly flat year on year. And as a result of that increase in margin drove the significant improvement in profitability. And that's a key point moving forward. And if I talk through some of the, I'll first talk through the overhead movements in last financial year and then some of the trends moving forward. So in last financial year, our focus on reducing our expenditure on overheads and driving efficiencies, as I've already said, resulted in the £2 million saving year on year. We reinvested that £2 million worth of saving primarily into sales and marketing. So 1.7 million of that expenditure was diverted from back office infrastructure costs and reinvested in frontline sales and marketing costs, both headcount, new incremental salespeople, and additional marketing spend. And that's part of our key focus, and you'll hear later in terms of one of our key strategies in making sure that we are investing in sales and marketing to drive continued top-line growth. And as a result of that, for the first year in the history of Trakm8, we spent as much money on sales and marketing, so nearly 5 million, as we did in total on our engineering spend, both what was capitalised and what we'd expensed. And I think that signals the shift in terms of us being not forgetting about R&D. We still need to maintain our level of expenditure in R&D, but in terms of that focus of driving the top line and investing in sales and marketing to achieve that. So both in fiscal year 18, both our sales and marketing expenditure and our total investment in R&D, as I said, both expensed and capitalised, was about 16% of revenues. There was another first this financial year, which was that our increased capitalised engineering spend increased by about 150k. Our amortisation, which you can see there, the 350, increased by more. So what you're starting to see now is the starting point as we flatline our investment in R&D, is that our amortisation of the costs will start catching up with the value that we're capitalising. And this financial year was the first year where the increase in the amortisation of the R&D that goes through the P&L, that increase was greater than the increase in what we'd capitalised. And you'll hear later, our strategy moving forward is to hold flat in pound notes terms our expenditure on engineering research and development. which will see that gradually decrease as a percentage of revenue as we continue to grow the top line. And to focus our investments on sales and marketing and continue to invest more on sales and marketing to drive top line growth, and at the same time continue focusing on our operational efficiencies to make sure that we are as efficient as possible, and therefore can continue in terms of containing our other overheads as much as possible. So hopefully that's given you a good insight in terms of some of the profit drivers, and just thinking through the impact of what I've talked through in terms of both from a profit and from a cash perspective. If we deliver on our objective in terms of overheads and continue to drive the top line, you could begin to understand that that leverage will play through in terms of improving profitability and improving cash generation. This slide, in terms of cash, moving on to cash, in terms of cash generation, excludes the R&D tax credit, which is money we get back from the government for investing in R&D. So, that shouldn't be, that's part of our investment decision in terms of how much we invest in R&D, is that we do get money back from the government. The 1.6 million in the last financial year, about 600k of that related to the previous financial year. So that I'm just giving you a view that the sort of underlying for the last financial year was 1 million plus 600k catch up. But what this graph does show is the strong improvement in the underlying cash generation, driven by the improvement in profitability. And we were pleased to reduce our net debt by just over 500,000, by 600k year on year. And this highlights the strong cash generation from operations and the continued investment in R&D. So that 3.7, 3.4 of that was the continued investment in engineering, which delivers what we believe is cutting edge technology. And they're the sort of two, and you can see the benefit of the 1.6 million of the R&D tax credit. But if you look at the 3.4 of that 3.7, you can see 1.6 last year, but ongoing about 1 million of that we get back from the government through the R&D tax credit scheme, which is part of them supporting businesses in investing in cutting edge technology. And we also get back about 500,000 from grants from the government. So you can see of the R&D that we do spend, we do get significant element back from the government. That hopefully provides some useful and interesting insights into the last financial year. And we'll now look forward, and what you will hear is next from Mark and then from John afterwards is some more insight in terms of our 3 key strategies to continue driving growth in the business. And if I put it in my simple terms, the strategies are: continue being as efficient as possible, which is number 1. Make sure we continue with the best solutions and technology, which is strategy number 2, and increase our revenues, which is strategy number 3. So if you say it in that simple way, it sounds easy. There's a lot to do, but we are focused on doing those 3 key things that we are sure will drive the future value and growth of the business. So with that, I will hand over to Mark to provide some more insight into the first 2 strategies.
John's already covered quite a bit about the operational efficiencies, but so I'll just draw a few highlights. As we said, we set out our target to achieve a £1.5 million reduction in our annual spend, and we significantly overachieved. We achieved a £2 million reduction through And this year was the first year where we benefited from the one-off effects of the consolidation of all the services that were spread out across the business into the head office functions, and allowed us to close our Bodmin and Livingston offices. We also invested in our people. We put in place a lot of lean training. That enabled us to look at the processes, and really get under the skin of where we were inefficient. And we put into place a number of process and technology improvements. One of the things that our customers like about us is that we have a fantastic product suite. It's a very highly configurable, state-of-the-art solution. With that can come a lot of complexity. And so we've invested in our CRM and our product engineering to enable us to abstract that away so that so we can deliver solutions without a huge amount of complexity from the people that have to deliver it. And that's enabled us to reduce at a headcount level our manufacturing labour by 21% and our general administration by 16%. We're also looking to continue the investment. We've talked already about the £1.5 million we intend to invest into our manufacturing facility. We've set our aspiration to scale our manufacturing operations to 4,000 units a day. And John will talk a bit later about why that's so important. One of the things we're going to do is we're not going to do it straight away. We're not looking to immediately spend 1.5 million in one go. We're planning to do it in stages to match the customer demand. We've started to make that investment already. We've done the things we can do without immediate capital investment. So there's been a strong focus within our product engineering teams to eliminate component count and improve the manufacturability of our products. So reducing the cost to manufacture the products. We've also designed them for higher degrees of automation going forward. We've made an initial investment in high quality automated test stations from National Instruments, the sort of equipment that wouldn't be out of place in an OEM or a tier 1 manufacturer. As we do more business with this sort of customer, it's important that we have the technology base in our manufacturing operations to enable us to service their needs. We also, one of the things our large customers like about us is that our products are very personable. They're able to be configured for their needs, even at a manufacturing level, to hit what they're trying to do. And so we've looked at how we do that, and the investment we're making in the manufacturing enable us to make that product personalization for the customers that we think is a differentiator for us. We're also investing in a new ERP system. We find that the current ERP system has some limitations, and the new one will enable us to really focus on our WIP reduction and our lean manufacturing. We're also intending to build out a CRM further. As I'll come on to later, we have a digital strategy. We're increasingly looking at self-service telematics offerings for our customers, and our CRM system will be a key enabler to that. So I'll talk a bit about the technology and some of the things we've delivered over the last year. Before I do that, I thought I'd talk a little bit about our 4 main verticals and what they look for from our technology solutions. So our automotive vertical is all around really understanding what's going on the vehicle and providing that data back to the customer to enable them to really drill into what's happening inside the vehicle. Our insurance is all around driver risk profiling. It's around understanding how the vehicle's being driven. It's also there's a very large overlap between automotive and insurance, because a lot of insurance customers also offer breakdown, and a lot of breakdown also offer insurance. So the two together take a lot of the same features. Fleet and optimization is the superset of everything we do. It's all about driving efficiencies for our customers, be that through driver scoring and coaching, through fuel savings, through the driver assessment, or through better planning through the optimization. It also has lots of bespoke features. We do a tremendous amount of integration into customers' back office systems. And so it's a very complicated product. Plants over to one side, it is a bit special. It sits within our automotive business unit. It's all around theft protection and asset utilization. And it sits within our automotive business unit because of the number of OEM relationships we have in that space. I'm now going to talk through some of the solutions in a bit more detail. The first of which is Trakm8 Prime. This is our digital self-service telematics platform for small and medium enterprises. It has all of the capabilities of our high-end fleet management solution. It's based on the same technology platform that we use to deliver Insight, but is tailored for a much smaller business where they may not have a full-time fleet manager. What's key about this is it's a fully digital experience for the customer. So they order online, they provision themselves online, the devices arrive through the post. As far as the customer is concerned, they never need to speak to a person. And what's also important about that is we have designed this for deployment into international markets. We see this as one of the key products that we will deploy outside of the UK. We've talked about the RH600. This is the first 4G-enabled telematics platform. It's a bit different from some of the early competitors' cameras. A lot of our initial competitors came to market with video platforms, but they had limited telematics offerings. And so they were a bit lacking for customers. As a telematics business, what we've done here is we've combined the video with a world-class telematics and fleet management platform to give them the best of both worlds. It is a no-compromise device that really a lot of fleets are seeing the benefits for their organisation. We see that video is a key source of additional data for our platform. And part of that is the ADAS algorithms, about how they feed both into different outcomes for our customers through in-cab information and into the scoring and the other data that comes back to the fleet manager. And I've got a bit of a video. I'll show you some of the ADAS features that are in this camera. So the first feature we're looking at is driver fatigue. So what we're doing here is we're monitoring the pupil response and the head positioning of the driver, and we're looking for micro sleep and inattention to the road ahead. And when we detect it, we're able to provide an alert in the vehicle, as well as feed it back into the scoring in the system. The next ADAS algorithm in the camera is we have forward collision warning with lane departure. So the front-facing camera is constantly reading the road ahead, and we're able to recognise time to the vehicle in front and where we are in the lanes. So we're looking for lane breaks. All of this feeds into the driving score and how the person's driving. Are they aggressive? We're also able to detect collision alerts and trigger an audible alert to hopefully change the outcome. The next algorithm is road sign and speed limit recognition. A lot of our customers use the telematics data for speeding enforcement and for their compliance, but even the best mapping data is only so accurate, and with the move to managed motorways, it's increasingly difficult to show what the speed is at that moment. Through the speed recognition within the camera, we're able to reflect that real-time road situation. It's also fully integrated into Insight, our next generation telematics platform. And so here's a scenario recorded from one of our cameras, triggering an alert inside the cab, and at the same time we're sending an alert back to the fleet manager so he's able to take intervention. The fleet manager, through the 4G internet-enabled camera, is able to immediately look at the accident that's gone on. He can also switch to the driver-facing camera and check that the driver's okay. And then able to decide what the next appropriate action is, be that send out a recovery vehicle or rearrange the route if he's a service engineer. We've shown you a little brief glimpse in that video of Insight, our next generation fleet management platform. So I'll talk a little bit about that next. Insight has been a big investment for the company in terms of the technology. It is a next generation platform, and I'll go into a bit more detail about the technology behind it in a minute. It provides everything we do. So from the route optimization, the scheduling, through to our existing telematics and fleet management offerings in a single pane of glass. Some of the feedback we've had from our customers is that are sort of second and third generation telematics customers is that lots of telematics systems give them lots of data, but they sometimes don't know what to do with all that data. Insight's been designed ground up to change that, to provide actionable insights to the fleet manager. It's running continuously behind the scenes, lots of algorithms, so that it can provide information for action, so that the fleet manager knows exactly where to focus his time, where he has issues, be it vehicles that need maintenance or drivers that need coaching, to enable him to get to save those efficiencies through managing his risks better. As I said, Insight's also a platform for more than the fleet manager. What we've done within Insight is we've rebuilt our platform, and we've started with a very flexible data pipeline. So at the edge, I might use the pointer there, we've got our ingest layer. The ingest layer of our data pipeline enables us to receive data from both our devices, from a number of competitor devices, and actually from the OEM vehicle gateways and mobile applications. So wherever we can get data, we can bring it into the data pipeline. It then goes into our message transformation services. What we do there is we're trying to provide a fleet manager with a mixed fleet of vehicles from different suppliers with different solutions, with the same high quality insight regardless of where the data comes from. So we transform it into a source independent message format that lets us be able to make comparisons between all the different messages. We then feed it into data enrichment. What we're doing there is we're adding contextual information to the data, whether it's mapping, weather, traffic, risk layers, and any other services that we need to take that data we're getting from the vehicle and provide additional data that comes from other sources. It then goes into our time series data store, which is now a highly scalable data store that's geo-replicated. We're seeing about 15 million messages a day going into that system, and that's increasing every day as we add units and as we add complexity to the product and more capability. And then we deliver it to our customers through all the usual methods, through web, mobile, through APIs. One of the big things we've been doing is we've taken a monolithic application and we've broken it down into service-orientated microservices. What that means is that every bit of our system now is behind an API of some sort or another. And that's enabling us to deliver value to our customers in lots of different ways. We now have all of the algorithms we use in the background available not just through our own mobile application and our web applications, but also available to be consumed as a service by anybody through an API key. And so our vortex optimization algorithm, our driver behavior algorithm, they're currently being purchased as just a service by customers today. And then, so through all of this enables us to deliver the services to our customers of optimization, of vehicle maintenance and prognostics, location-based services, the analytics into how the fleet and the driver are performing, and also help customers with their compliance and compliance management pieces. And now I'll hand over to John, who will talk you through why this is all so important.
I think you can tell from the passion in the last slide how important Insight is to the company. I think it's fair to say that Trakm8's been on a number of journeys all at the same time. We've been moving out of CEM, we've been consolidating acquisitions, we've embedded deeply into our business the culture of trying to do more for less and being more efficient at all times. I think we do have the best tech. I now believe we have the best tech available in our spaces. And so actually, it's a really simple strategy now, and that's just sell it everywhere as hard as we can. We declared the ambition a little while ago that we wanted to get to 1 million connections. It is an ambition, not a forecast, I hasten to add. And we declared where we think that could come from. And we've indicated that we think we can take fleet from its current 70-odd thousand to 200,000. We've said the insurance space can go to about 300,000. And automotive, you can see, is the biggest step change from a relatively modest number as of December last year to 500,000 connections. It sort of addresses the question as why we need the sort of capacity that we're anticipating in manufacturing. There's attrition in all these areas. Our attrition in fleet is actually probably lower than most. It's sort of sub 10%. But the insurance space today, attrition, i.e. the number of vehicles that today are installed that will still be installed in a year's time, is around 50%. And so that's not us losing market share, that's actually the insurance customer not having the same policy or the same vehicle 12 months later. So we have to cope with attrition to stay the same. We have to, to be at 1 million devices, we actually have to sell 250,000 just to stay at 1 million devices. And then, of course, we are growing. So potentially we need 50,000 devices a month to get to the 1 million connections that our ambition sets. It's worth having extra capacity because there's a truism in manufacturing that if you have spare capacity, you can reduce your lead times, you can reduce your WIP. And so actually, it's part of being more efficient is to have a bit of excess capacity. You'll see a picture of the National Instruments. It's a generic picture, it's not what we're putting in place. But having automated tests that's capable to be driven by robots gives us much more throughput, gives us much higher quality. And the stuff that we've done in terms of having less component count means that the big investment we've made in surface mount capacity, which is the investment we've made in the last few years, is actually fine. It doesn't really need replacing. So here's the big question, and it was the one that I was asked by Buchanan, is why do 1 million connections matter? And it's all around maths. And please be clear, this isn't a forecast, but the maths the maths answers all the questions. I've made some assumptions here, and the assumption is that the trend of doing more for less is inevitable. The sell prices of hardware and the sell prices of services to go with it will go down. It'll continue to go down quite quickly. It might go down by as much as 25% over the next 3 years. We think that's pretty much inevitable. But the good news is we know how to make our costs go with that. We can protect the margins. We've talked about the fact that, last year was the first year ever that we spent more on sales and engineering, and our plan is to continue to spend keeping the best tech, but try and keep that as a proportion of our turnover declining. We're not going to reduce it in pound notes, but as a percentage of our turnover, it will decline. And our objective is to end up at around 10%, which is probably a sensible ongoing run rate. But we do want to spend more money on sales and marketing. So we're currently, last year, spent 16% of turnover on sales and marketing. We're targeting on spending 20%, and hopefully that's 20% of a much bigger number. The other costs, the overheads that we all have to wear as a burden, is designed to come down as a percentage of sales. So those are assumptions. The rest is maths. If we achieve that, then recurring revenues will grow considerably over that period. The installed devices will drive that. As a percentage of recurring revenues, overheads will get fully funded by the recurring revenues by that point. And so what that means is that at that point is the profit is equal to the gross margin on everything else we do. So it's the gross margin on the hardware, it's the gross margin on the optimization, on the consultancy, on the grant income. And the guys who are good at maths will figure out what that means, but as it's not a forecast, I'm not saying. From a cash point of view, now we're in the situation where the money we get back from the government, our amortization, is pretty much in line with our engineering capitalization. We are in a situation where, subject to managing the working capital constraints of growing the business a lot, we should be able to turn profit largely into cash, which will be happy days for all of us. So how are we going to get there? Because it's not a trivial task. It's big ambition. Fleet is the area where we have, to this point, invested the most in terms of engineering, in terms of sales and marketing spend. And so we plan to continue to grow our UK direct sales team. We're very successful in the UK. I think we're considered to be the one that everybody else has to shoot for now. I'm pleased to say that we've got some new hires that are coming soon that will make a big difference to that team. We'll watch this space on that. Our UK telemarketing team is ramping up, starting to get some traction, and we're very pleased about that. We used to outsource that. One of our acquisitions, Box Telematics, and to an extent Route Monkey, come from a background of winning a lot of their business through channel partners. It's an area where we think we can do a lot more, and so we're expanding that team, and we've made some interesting hires to help manage that business. And that gives us an opportunity to find channel partners outside the UK too. Our digital program, Mark talked about it, it's scalable into other markets so long as we have the sales and marketing dollars behind it, and we need a little bit of tech support. But fundamentally, it's a bit Amazon-esque in the sense that it doesn't actually need to interact with us. And we do anticipate establishing a physical presence in Asia in this period of time. It provides us some operational advantages, but we're also starting to build a customer base out there where local support would be very helpful. Insurance. We believe that our existing customers and a couple that are imminent, and I hope imminent, could achieve 75% of that ambition. So to get to 300,000, we could feel and touch the customers that can give us that level of demand. And we just need to find a few more. We think we've got some very good people in the space. We think we've got great tech. Our crash detection algorithms work really well. Lots of features that we have now that give us market-leading position. And it's just a question of, we know who all the insurance companies are. They're not hard to find. It's just a question of persuading them to work with us. The automotive connections, which looks like the craziest ambition to have, to go from sort of 20,000 to 500,000 in this time, actually existing customers have the potential to give us 65% of that. The customers we have today have huge ambition themselves, and if we can, the premise in all this is that we don't lose any of our customers. Our history is good. We tend not to lose customers, so we can get a long way towards our ambition by working really hard and successfully with existing customers. But there are lots of people out there that want connected car data. They want to organize service outcomes. There are lots of leasing customers out there, and again, we know who they all are. It's just a question of working with them, getting them over the line. And we are building a presence with niche OEMs. If I'm honest, I have no expectation of getting a really major OE car company. But there are lots of vehicle builders that are looking for the sort of services we provide and the level of support they can get from us that they wouldn't get from a tier one or whatever. So that summarizes what we plan to do. Basically, we've made very strong progress on the last 12 months. We have continued to have contract wins even in this financial year that we've announced, and hopefully more to come. We are investing heavily in sales and marketing to make Trakm8 a much more substantial business, much larger business. And we think we've placed ourselves really well for that. And as we've announced today, we're confident of meeting market expectations for this financial year. So we've got to the stage, pretty much on time, of getting to questions and answers.
Hi. In terms of the million connection target, could you elaborate a little bit what that means for your market share and kind of what the competitive landscape looks like, and are there any other players who you're concerned about as you embark on this challenge?
I'm always concerned about competitors. It's slightly hard to give you a market share on the automotive because clearly connected cars, all new cars are connected cars pretty much. In terms of the aftermarket, there aren't too many alternative players doing what we're trying to do. In terms of insurance, there are quite a lot of people, and of course the there's an Italian company that has a giant market share. In fleet, I mean, to answer your questions, because I think I can, to get to fleet aspirations, we probably have to double our market share. In terms of insurance, we probably don't actually have to increase our market share that much. And automotive, I don't know the answer.
The availability of market research has got much worse. Some companies are now placing their house broker projections on their own website, which for many of us is very helpful. There's great talk of market expectations, which a lot of people, including institutions, don't always know what it is.
Right.
Could you please address that? It's a question of you doing a deal with Arden, probably.
Well, I've noticed, I've actually noticed that increasingly brokers, house brokers, are actually doing that. And you'll be unsurprised to learn that I actually have asked Arden if they would do the same. And I can't answer for them. I hope they will. Certainly, we have a gentleman in the room who's just left a company that has now just done that.
Sorry, yeah, we discussed this point this morning because their previous broker has now got to a point that they can put it on the website. It's been a bit of a wrangle for all stockbrokers post MiFID and just getting their head around some compliance rules. Normally that's compliance departments working out, and then it's an IT department. So hopefully fairly soon.
Well, thank you for the asking question, because I actually think it's a very good point, well made.
Another question.
Yes.
About your the grants and the R&D payments that you get from the government. If you're now running this company, not for cash, but more for cash than you were, and trying to deal with it in a different way to how you were, isn't that going to affect the amount of payments you recover from the government?
Well, I'm not the expert on how the calculation works, but fundamentally there's a percentage of what you spend that complies with the rules. So if we spend 5 million, a percentage of the 5 million complies with being innovative and meets the various revenue tests. And then you get a percentage of what you spent as effectively as a credit. And how much of that comes as cash slightly depends on how much profit you're making. So there are some interactions with that. But fundamentally, the government pays us about £1 million of our £5 million spent.
But if you spend less, you're going to get less.
Yeah, we're not planning on spending less.
A detail that there have been what look like historic acquisition costs going through the numbers each year. Are there forward obligations still, please?
In terms of commitments to vendors and so on? No, none.
Just a couple of questions. I'm still not quite clear why you actually have to expand your manufacturing base. I thought this was an IP company with lots of clever algorithms and things like that. Why do you actually have to get into the physical ability of manufacturing?
We would not have to manufacture our units. We would not have to manufacture our units. It'd be perfectly possible to take our designs and get them made by somebody else. One of the reasons why we think manufacturing is helpful for us is time to market. We launched the original self-fit device almost exactly, well, just over 4 years ago now. And we went from a design prototype to 2,000 samples for an initial trial in 3 months. And we went into manufacturing and production in another 4 months after that. If we'd been trying to manage third-party supply chains, that would have been exceedingly challenging. We do test what we do against external vendors, and indeed Mark's done quite a lot of work on that. But what you find is that the subcontract manufacturers, they want 12 months absolutely guaranteed stability in terms of the product that they're going to put down their lines. And they want 12 months commitment to, because components are on 52-week lead time now, by the way, some of them. And so they want 12 months guaranteed schedule demand. We want the flexibility to be able to change our designs in less time than that. And frankly, we want to be able to protect ourselves from the stock risk of having stuff on shipment from China, perhaps, and not being able to stop it if we didn't need it.
So the second question is, to get your 1 million connections, can you just finance that yourself, or will you have to find a new source of finance?
We do not believe we need external finance to do that.
Thanks. Hi. You talked about expanding the platform sales to Europe and other Asian countries, etc. Can you give us an idea of how, in terms of translation and fitting with the particular needs of those markets, how much granular work you've done on that?
Well, if we talk about Asia, we've already announced the contract with Telematics in Australia. It's another roadside assistance opportunity to address primarily the Australian market, but actually there are other markets. As it happens, most of their targets are English speaking. In Europe, it's different. I mean, we are already shipping to half a dozen roadside assistance businesses in Europe within telematics. So, and language is actually not an issue for that. Fleet, it's an issue. And our platforms are very easy to translate, so that the product's not a problem. It's then a question of support and sales effort and marketing effort. And that's something that we're doing to prioritize where we go next.
So when you say platform is easy to translate, have you actually translated them?
Yeah. How many languages?
It's about 8 currently, including right to left and all the difficult ones.
Including a funny one that goes the wrong way.
What's the plan for electric vehicles and driverless cars? Because surely much of your the data from those falls away compared to conventional vehicles.
As in everything, electric cars, autonomous vehicles are a threat and an opportunity. As it happens, the route monkey routing and scheduling algorithm is I'm not sure if it's unique, but it's certainly particularly effective in situations where we have mixed fleets, where we have electric vehicles and non-electric vehicles, because we understand how topology affects the battery life. And so we schedule journeys understanding that, built into the algorithms. And so the moment a fleet has 5 out of its 5,000 vehicles that are electric, that becomes a feature that we have that others don't. Mark's already pointed out that we can absorb data from the vehicle. The vehicle gateway is available to us. And so our whole system is designed to make us device-free if we need to be. And so there's lots of things that electric vehicles, a lot of people have this range anxiety. We have something called My Route Monkey, which is an app that helps people plan their journeys. And so there are lots of features of electric cars that actually play to our strengths.
Cameras. There's a company called Seeing Machines, which does part of what you're doing. And how many other competitors? Do you make your own cameras, or are you buying them in from somebody like Seeing Machines?
No, we make all our own, and our algorithms are our own. We haven't licensed the Seeing Machine algorithm for our driver distraction, and we haven't licensed Mobilize algorithms for our distance to the vehicle in front algorithm.
And so how many other people like Seeing Machines are in your market?
Well, Seeing Machines is in our market because it's licensed its technology to a couple of the telematics providers. But we're not paying license fees to anybody. And what we do is very good. I'm not making any claims to whether it's better than Seeing Machines or not. I mean, they're OE. We're not trying to be OE with our video algorithms at this point.
But they could license to your competitors. I mean, the fact that they're OE is okay, right.
So, it feels like we've got to the end. Thank you very much.